Hello, and welcome to an introduction to New Frontier. In this webinar, New Frontier Chief Investment Officer Robert Michaud will provide an overview of our investment philosophy, process, and strategies. The presentation is excerpted from a quarterly Market Perspectives webinar recorded on October 8th, 2020. If you have questions about anything covered in the video, please feel free to reach out to us at nfglobal@newfrontieradvisors.com.
So, as most of you know, we are a core portfolio manager, and our investment process has definitely the long-term investment objectives associated with it. But long-term, as you know, means that you cannot ignore what's going on right now in the short term. We often say that to be long-term optimal, you also must be short-term optimal. But if you're only focused on the short term, then you will not be long-term optimal. So I think 2020, if we can all pretty agree, has been quite a dynamic year. And so I think this is a good time to highlight the dynamic approach that we take to strategic asset management. We have for a long time said that we are strategic asset managers, but we're not static asset managers. Our investment process does adapt, and our portfolios change over time. It's not just about rebalancing once a year. So just to give you an overview of this, let's start with things that really all investors should be able to agree on. You may know we have a mathematical background around here, and mathematicians like to think about axioms to build upon. And so the axioms of investing are things that we should all think are solid foundations to build on. And pretty much we all should be able to agree that risk is important. You have to account for that when you're building portfolios. The correlations between asset classes matter, and then you need to find some way to balance the trade-off or optimize the trade-off between risk and return. And other things that are more not always done, but definitely true, are that asset characteristics, risk and return and correlation between asset classes do change over time. Factor relationships change over time. And the future is uncertain, and you have to have some way of accounting for that. So how do you put this all together? Now, that's not so easy. So let's go through our investment process. So our investment process thinks about what are the right types of asset classes to invest in, what are the identifiable risk premia, diversifying assets. This is particularly important at times like this, when we don't know where growth is going to come from, and we don't know which part of the economy is most likely to be affected by events such as a pandemic. And then we need to estimate risk and return, build portfolios, and then monitor and rebalance our portfolios when necessary. So building capital markets. So this is a great example of over the course of 2020, there has been China has gone from being a very risky economy and asset class to one of the not particularly more risky than any other economy type of asset class. People who've seen tech stocks and growth stocks, things that are likely to continue to do well in this type of environment, as things that are much less risky than they had been before, and so demand for them has increased. Right, so it's undeniable that risk and return have adjusted, and that you need a capital market framework of adapting to that. And so we've had this framework that has taken into account not just historical information, not just economic theory to put some structure on it, but up-to-date market information, what the markets are telling us about risk and return of different asset classes right now. So certainly things like the yield curve and credit spreads are all very straightforward to measure and include in your investment process. And that has contributed to a lot of the dynamism of our portfolio strategies this year. The other thing is optimization matters. And so I think it's particularly important, again, to not just have a portfolio of stocks and bonds, but to actually have an optimized portfolio that allows you to take clever combinations of asset classes to maximize return and minimize risk, and really adapt to a changing market environment. And this is one way that even if you don't have superior information about the future, that you can just build a better constructed portfolio that's more resilient to different risks and will likely, on average, perform better over time. And certainly this is something that we have been experts in, and indeed is the reason why we founded the company, because we are experts in optimizing over uncertainty. We literally have been examining thousands of potential future scenarios in every time we build a portfolio. And this, of course, includes all sorts of things that you might not expect. We didn't explicitly have a pandemic scenario in our portfolio, but the statistical procedure we used included events that might look in data something like this. And it's nice to have independent researchers, especially Nobel laureates with the credibility of Harry Markowitz, agree with your research. So the other thing that you want to do is you want to be paying attention to your portfolio on a daily basis. And I like to illustrate our rebalancing, which is something that we do every single day in our process. And we have our current portfolios that we optimize to when we build an efficient frontier. But then we watch and pay attention to the portfolio as prices change. And we also pay attention as the market environment changes and the whole definition of optimality has changed. And so both of these things have been happening in a dramatic way over the course of 2020. And so it's been critical that we've had our rebalancing and portfolio monitoring process to be able to monitor the changes on a daily basis. And this has kept the investment committee extremely busy in 2020. But it has been important that we have been able to maintain appropriate risk control through this environment and keep our investment process going during a pandemic. And so how this has all played out is it has been a very intensive time here. We've had to keep up with very rapidly developing events. We've always had a process that monitored portfolios on a daily basis, but you have to really look at it on a daily basis. You have to really pay attention to the changes almost sometimes from day to day to make sure that the portfolios are still behaving the way that they should be, do still have the right risk exposures, and can still be considered optimal. We've had to be much faster during this time period. And in fact, we have, in the last 12 months, we have rebalanced 4 times, which many people, for standard strategic portfolios, which is unprecedented, and many people might want to know how that has played out. But I think it's important to consider that we've maintained our principles during all of this. It's important that we've stuck to our investment process. We've continued to adapt our investment process. Much of it already was dynamic, and so it was naturally adapted. But when structural changes do happen, like I've already given the example of China has sort of changed its structural character in terms of its relationship with the rest of the economy and its risk. These are parts of the investment process that you do have to be able to adapt.